Thanks, Hardeep. Mike, nice to see you. Thanks, everyone, for coming. Perfunctory matter, we have our own polls. They have not been responded to yet. But if you go into your app, you will find the question for this panel, which I think goes at sort of the historical, one of the great historical debates of this entire space, which is how big a return premium are you willing to accept? Did I write that wrong? How big a return premium are you willing to forego for ESG purity? I may have written that wrong. In which case, let's go with what I said rather than what I wrote. And the options are 5%, willing to pay a little bit for purity, 2%, not insubstantial, 0%, because why are we actually here? Are you crazy? Which is a response that vast swaths of the economy might give. And are you trying to get me fired? What do we see? So, 0, what do you guys think? What would you expect? Obviously, I think in this room, where nobody's going to say that that's the craziest question I ever heard. But is that about right?
Yeah. Well, my sense is it really depends on whether you're looking at the private markets or the public ones. So if you look at private markets, particularly like real assets, if you're managing a portfolio of buildings or farmland and you're not looking at energy conservation or renewable water sources, your asset is going to be worth less. And so it's more than 0 if you don't take into those factors. Public security is a little harder because there's other variables that inform what the valuation is. And so my sense is part of it, but there may not be as direct a correlation. And so 0 is probably more of a logical place.
Sure. I mean, who wants to lose money?
Exactly.
I think the issue is going to be help convince me that what I'm doing has positive externalities. And that's another thing on top of the premium that gets factored into any calculus. And everyone's going to have a very, very unique view. And so what we like to do, again, is push that to everyone versus kind of having a general view and pushing that on everyone. Some people want to do good as well as make money. Some people are not willing to make that trade-off. But I think there's enough research out there that says doing good is good for your soul, but it's also good for your wallet.
I think it came up earlier this morning. The question may be not just return, but risk-adjusted return, right? And so what we're finding is, and you see it sort of weekly, the tech company of the day blowing up because of governance issues or some things like that. So what we're hearing from financial advisors is that the term safety and risk reduction is being more aligned with responsible investing. So it's not just a return question, I think it's a risk question as well.
So it's 3 variables, really, is including values. And values is it's sort of an endlessly interesting topic because it's very malleable. One question that maybe people who wouldn't show up to an event like this might ask is like, which are the best values? Because those, which values are going to make me the most money? Because those are the values that I'm really into.
So we actually, when we launched our Motif Impact product, we ran this risk. A lot of our survey data said people aren't willing to trust you, even if you say that there would be no penalty to doing good. So we actually had to launch an insurance policy. And what we did for the first year, we said if you take an ESG tilt on any of our portfolios and it underinvested the benchmark index, then we would actually credit you all your fees and make you whole. And that was a pretty big risk for us, so we had to do a lot of soul searching ourselves. But sometimes it takes a big leap to convince people that, no, these people are willing to put their money where their values are, and we can allow people to actually make that trade-off.
I think that's super interesting, and I want to stay on that for a second, because what you just said, I think, is emblematic of the whole debate, which is that was a big risk for us. But if it's a no-brainer, that people should invest in ESG, and it's such a no-brainer, then you're willing to take out an insurance on your product, then what's the risk?
Well, my take on this, I think people do care and want their values aligned with what they're investing. Not everyone, but more and more folks do. But they also want to know that they have enough income in retirement, and they not want to lose their money, right? And I think those other financial factors, when you look at an overall portfolio, are as important, right? And so the idea of expressing a preference, which you may find in sort of self-directed investors, when you're looking at clients that are working with an advisor, they're looking not just at where their money's going, but are they in fact going to be able to live after they retire? Are they going to be able to preserve money to hand down to the next generation? So from where it's not really a pure sort of an approach that I think most clients are looking for.
Makes sense.
Yeah, and I think for us, it's like we were pretty confident, but there are always externalities you can't actually control. A company that's doing good today might suddenly turn bad. And so there's always that emblematic risk because you're not in the boardroom. You don't really know what the motivations of companies are. So in any investing, there's inherent risk. But generally speaking, we were willing to take it. It worked out for us. And that's how we convinced folks. Interesting, even after that, people didn't believe us. And so a lot of them were like, we're not going to take an ESG tilt. We'll invest in what we think is good. And then the other angle to this is a lot of people prefer to invest in just things that are instead of an ESG tilt on an index or a model, investing in clean tech or investing in solar, those direct investments tend to be things they can get their hands around in more traditional ways.
One thing that's been interesting, particularly given your work, is that the element of time is becoming more pronounced in ESG investing. And I feel like maybe 5 years ago, when the field was much smaller and maybe a little bit slower, is that a good ESG bet or isn't it? And it was like a one-bit sort of conversation. But like, if you're able to just click around and change your portfolio so quickly, how does that change? I mean, things could be falling in and out of the ESG universe by the day, if I'm not being too naive.
I think it's a good insight, and I think that's one of the troubles with managing a portfolio is that if you identify something that is sort of negative from an ESG perspective, it will potentially take a long period of time. You may have bad governance that can work for a period of time, but at some point it could go south, and you may have to wait for a period to do that. The other thing is the data itself is not great. Right? So we talk about all the product and all the output, but the reality is even the providers of the data, we're spending time helping them clean it. It's just not in a form that is entirely reliable, and issuers are not consistently pushing out information. So there's a lot of noise out there, and when you're investing money on an active basis, there's hundreds of factors. You're trying to figure out what's material, right? And then you're looking at that over time. I think folks want to see that there's signals to drive performance, but I think in the end, it's how can you look at that to inform a broader-based decision on security selection and the like.
So that's a problem that's external to your control because it's just about data in the ESG space. Like, how does that problem get fixed? I mean, we're seeing a lot of conversations about standardization, whether it's green bonds or ESG scoring. Is it getting fixed?
I think one way it gets fixed is you sort of follow the money. So when you're making investments in capital and a company is looking to raise money and we say, well, you should measure this, or like in our bond funds, we want to insist on certain measurement of impact, or we're not going to invest in your bond, that's going to drive issuers and companies to change. And so I think the capital movement, which is driven by, in the end, investors, I think over time we'll get the standardization going because companies will have to do it. I also think the general demand is, there's sort of a ton of money and interest in data, so there's a proliferation of providers of data, and all that will sort itself out as the broader environment matures.
I think the problem with data is there's just too much data out there. 90% of all the data created since the dawn of humanity was created in the last 2 years, just to give you a sense of scale. And so there's kind of two ways to tackle it. On the customer-facing end, it's about serving nuggets of information that are important when making a decision. So for example, You can go and put data in front of a client that says, did you know that 2/3 of the industrial greenhouse gases are emitted from 90 companies? Would you like to know who those 90 companies are? And would you like to screen them out of your investment? You can actually surface a lot of nuggets of information at the point of sale, if you will, to help coach and inform and allow them to make their own decisions. On the notion of building financial products, a lot of the problem with ESG is without transparency, you can't really do that because it's so much subjectivity in the companies that are going in. You've got to give people an opportunity to see who is actually building the products. And in our approach, it's algorithms, right? We prefer to take the human element out of it, and we'll have algorithms that are very data-driven, systematic, so we can sit down with a pension fund that says, where our charter says we can do no harm to labor, so show us data that supports that trend. And what we're doing is we're mining news data, patent data, so that when we're building a clean tech portfolio, it's actually driven by algorithms studying data that produce it. And then we're saying, we're not the human element. You're the human element, Mr. and Mrs. Customer. You tell us what you want to do, and we will systematically change that portfolio for you.
Right. So I would say in practice on the active side, which is a little different, I would say we're fully integrated. So today we receive data from multiple providers, including our own sort of structured data. It gets put into a lake. We create materiality on that data. So we look at what data connects to revenue of the company, and then we actually put that into all the Bloomberg terminals on every analyst and portfolio manager desktop. But that still doesn't get you to where you want to be because each analyst and portfolio manager that's managing a particular mandate has to think through, we have all this information, how does it actually get embedded in my investment process? How can I use that information to drive alpha, right? And then it goes through and finds its way into the portfolio. And you can do this across really every security, from loans to equity to bonds.
Mm-hmm. Your presentation is so striking, and you built a neat thing, right? So with any innovation, the question of disruption is never far behind. Like, who is Motif? Whose lunch are you trying to eat, I guess, is ultimately the question.
Oh, and I don't want to poke the bears either, so they'll come after us. It's interesting. Our biggest competition are actually our biggest clients, the large investment firms. We survive by staying a couple of years ahead of them. And so our notion is we are very, very focused on one thing, thematic. And thematic is actually more and more shifting to positive impact themes, which is how we've evolved into the SRI space. And so for us, it's really a combination of technology firms that are looking at this space, the traditional quant firm, but it's also active investment shops. And today, we prefer not to compete. We tend to partner. And that area of intersection is very, very important because I think ultimately what's going to happen for responsible investing to take off, I think you're going to see more and more of responsibility tied to direct indexing, to models where people can express a view. And then there are going to be other models where you're going to pick a trusted party, an active firm, where you can get very programmatic about a better set of values. The challenge for us is we think the data is pretty poor, so it's very hard to do ESG integration, even with the best of data out there. So I think for us, it's the positive themes, the ESG screening. Integration is very important. And across all those themes, there are different players that are very strong in that space.
Yeah. I think firms like Motif are really, what's great about it, just sort of pushing the envelope when you see what the possibilities are. If you look at the larger wealth management providers, if you're a client and you have, say, $1 million in a portfolio across different types of products, today you open your account or you get a performance report and it just has all the financial metrics, return, risk, how you did, your cash flow. It has nothing on responsible investing or ESG, right? It'd be great to have one page that says, well, this is the carbon emission impact that your portfolio had, but that is pretty rare today across trillions of dollars of clients. So my sense is when folks see this, it's how do you get to integrate the reporting? I think reporting is probably the biggest part of making it more adopted so that clients can actually see But it's today, most clients that work with an advisor really can't see what the portfolio is doing for them from an ESG perspective.
And I think there's an opportunity. I mean, there's something we can, believe it or not, learn from the food industry, right? We started not knowing what we're eating, and then there were guidelines that you have to disclose the ingredients and nutritional value. And then there was the notion of we're going to put USDA organic stamps on. So there is a role for regulation, and I hate saying that word too loudly, but there is a notion of help us help you. And I think pretty soon retail investors are going to demand to know what's in their portfolio. As a Yale alumnus, there was all this commotion over the Yale-Harvard game of people protesting their endowments. Students are doing that. They tend to be the most vocal element, but it's dormant there. And I think when people see that there's an opportunity to vote with their investment dollars, it's kind of ironic today that everyone can vote with consumption dollars, right? I'm not allowed to buy a Canada Goose jacket because my wife doesn't like the way they treat animals. No matter what I do, I can't buy that. And so retail investors are very used to voting with their consumption dollars. I think what we're going to start to see is people start to vote with their investment dollars. But to do that well, you need to have a list of ingredients, if you will. You need to have a sense of there. And I think there will be a process pretty soon where people are going to start demanding that of their endowments, of their pension funds. I need to know what we're invested in at a minimum, and then you can start to do that. Right now, there is no free flow of information, so retail investors can't vote with that. But that problem is going to get fixed pretty soon.
Yeah, my sense is how all that kind of makes its way down to product. I think there's sort of proliferation of products, some good, some not so good, that will eventually get narrowed down quite a bit. And so you'll end up with a set of, call it funds or separate accounts that are unique and focused on impact-related assets like green bonds and the like. But everything else, it's just going to be embedded in what we do. And so right now, and I would say U.S. is a little behind Europe and Asia, but in other parts of the world, it's really table stakes even to compete for certain types of businesses. And so everything will get infused, will be integrated with these factors because they just inform security selection. Mm-hmm. And I think you'll see less, you'll have a category of ESG product, but it's largely just going to be part of what's already out there.
We do see European regulators taking a closer look at a lot of themes within ESG or climate or whatever the day's conversation is. Are there specific things that you think sort of will keep the train on the rails when you mentioned your analogy to the food industry? I mean, is it that simple? Is it labeling and transparency or what else?
I mean, that's just the starting point, right? The biggest problem we have, and in the earlier panel today, a single stock like Tesla, right? You can credit it on its environmental impact, but even that's murky with the notion of batteries and the producer of batteries. But then you have the government issues. So that's only a starting point. And I think what people are looking for, it's different for institutional investors because a lot of them can sit down with the fund manager and actually ask and get a lot of direct feedback. But when it comes to mass market investors, in Europe, we're seeing that in the data too, is particularly sensitive. We can't explain why, we just see that it's there. And I think a lot of it has to do with the government policies that are being enacted over there versus in the US. But I think you've got to be able to not just show them the data, but at some point, me as an individual investor, do I trust the fund manager to vote in the ways that are consistent? Not just vote proxy voting, and that's a different issue as well, but vote dollars consistent with that view. And there have been studies in Europe in particular where there was a study done on ethical funds. That used to be the old term. And there was evidence to show that ethical funds were actually less ethical than non-ethical funds. And there have been, so this notion of there's been so much brand confusion on what term do we use, how do we go in, and just because you've branded something organic, inverted commas, does that actually mean that? We have that same problem in the food industry. Do we really trust? Are there issues there? But we're so far behind there. And what makes this different than the food industry per se is the notion that a lot of this is gray area, and it requires a lot of values are very personal. And so the notion that we're going to standardize and come up with some taxonomy, I think that works when it talks about positive impact themes. I want to invest in water infrastructure. I want to invest in diversity. I think they're easier things to get you around. But if you're doing things like screening and all that other ESG, traditional ESG tilting, it becomes harder because you're not getting full visibility into the theme that you're investing in.
Yeah. Well, hopefully regulators don't have to, sort of set standards. I think industry groups can do that through SASB and the like. And we definitely need more standards. I think that will help with the communication and understanding of what's out there. And then what I think is even more important is just the return on these sorts of factors for companies. So, if a diverse board will lead to higher share appreciation, that's going to be a bigger driver in the end than just thinking that it's a good thing to do, right? And so my belief is that there's a whole host of factors that are out there, they're popular, but in fact drive investment returns and are good for companies to focus on. Again, if you own a lot of real assets across your company, a lot of real estate, you're going to want as much energy efficiency because it's just going to save you money and hit the bottom line. So I think that standards as well as sort of efficiency in the corporate space will drive a lot of this.
Get ready for questions if you have any, and one or two more questions, I'll turn it over to the audience. This is a question. It's almost general enough to be not only applicable to this space, but like whenever you're talking about any kind of change, like you've got young people who know what all the new stuff is, and you've got more senior people whose mental models are older and are working from sort of, you get up, you go to work, you do what you've always done. And so when you talk about embedding this stuff into workflow, like these are very mundane things. Like people have to change what they do and how they hold conversations with clients. How does that work? Like, how does it get baked in? I mean, like, all this is part of it, I suppose. But, like, how does change happen on the individual professional level?
Well, I think, like with anything else, you listen to client demand. Unfortunately, millennials don't have the money yet, right? And so when a wealth management firm is looking to invest, they're trying to respond to their clients. And I think, again, earlier this morning, we heard that it's not just the younger clients, but the older ones too that are looking for it. And that's driving investment in these large systems to help report. And I think it's just a technology investment matter in the end, responding to that demand. It's not a rocket science thing. The data underneath needs to get better, and it will. But in the end, it's like any other piece of data, bringing it up into the systems that you use to serve your clients.
Mm-hmm. Millennials are very sensitive to this space. They crave simplicity, but they don't want simplistic. And so the transformation of investing to digital distribution is actually going to spur a lot of innovation in this area. I think the other point to make is that the problem is there's a lot of intent, but to your point, even 10 years from now, Gen Xers will still have more money than millennials. And so there is this slow evolution with a very active group that don't have money yet. But unfortunately, it's going to be a ways before they even overtake Gen Xers, let alone the other generations. So I think it is going to be one where that'll be a natural curve. But our data supports that yes, there's a preponderance of interest within millennials, but it really cuts across all demographics to different degrees.
Yeah, I mean, maybe a different topic altogether, but how clients are serviced digitally in the financial sector is just still behind.
Yeah.
Right, and so this will benefit. If you can engage with advisors and clients in a much more sort of digital way, this will just benefit from that. But the way clients are serviced today, I think, is still dated from where we are.
Yeah, we have a social model on our platform where investors can talk to other friends and share ideas. And what was fascinating about it is they typically share with 4 or 5 people, unlike your Facebook social network where you have 500, 1,000 friends. Investing's pretty intimate. And it's interesting, those conversations that investors have with each other, I think you're going to need an expression capability, whether it's with the advisor sitting down with a client And there's a lot of training that needs to happen because this is something that is pretty foreign to even the financial advisors. And I think they're looking for ways to help educate their clients. And it starts with them getting educated first. And so with all this confusion in the industry around standards and how to do it, I think we've got to settle on some best practices, and that'll actually shape up the acceleration of these trends across the different fields.
Okay, thank you. Lauren, what do we got?
Hardeep, we have a lot of people asking for you to talk about the criteria that you use to determine which companies to include in selected portfolios.
So what we do, let's take the clean tech model, for example, is we upload a ton of data. We'll upload patent data, academic papers, financial data, CEO speeches. And what we have developed is something called an NLP. If you're not familiar with it, stands for Natural Language Processor. And think of a Google web crawler with an investing brain. So what we do is we unleash these Google web crawlers with an investing brain on the data sets, and we ask that crawler to give us the companies that are doing interesting stuff in the clean technology space. And we will screen out complaints and a whole set of other things in that model. And when that portfolio gets constructed, it not only finds the companies, but we create a relative signal strength. So if we're looking at patents in the clean tech space, for example, we will thematically weight the portfolio so you're actually getting exposure to the underlying trend. And when we're all said and done, we write it all in code. We're just a team of engineers. And it self-learns. New data comes in, it populates and goes in. So it is a very systematic process. The only human insight in this model is coming up with the idea to invest in clean tech. That comes from a human expression. But after all of that, it's machines and algorithms doing that. And it actually, in this case, gives you a positive theme and getting exposure. And you know the theme itself is an impact theme.
Another one for you. Why do you think Motif is successful when Swell failed?
Oh, I think so much of these models are about empowerment. So much of these models are about actually proving to investors that it actually works. And the notion of pulling together a family of funds and just that's not enough to go in. And there are a lot of other they're niche robos, for example, that are doing well. But I think it is about an engagement model. It is about actually getting clients to talk amongst themselves. And we tend to stay out of the picture. We create the tools, we create the level of empowerment. And the most important metric we use is it has to be simple yet powerful, right? And a lot of products that are simple stay simplistic. And the notion of I'm going to create an asset allocation model, but everyone in the room is going to have the same model, and that's the fundamental flaw with a lot of robo models today. You have to give people personalization. And personalization, we've seen it outside of the investing space. With responsible investing as well, you can't talk about ESG without the notion of personalizations, and very few companies can offer that level today.
Mike, let's have you take this one. Is SASB enough to get real standardization done, or do we need more detailed direction or more guidance?
I think SASB can drive it along with other industry groups. Again, my comment earlier around where the capital is. So when you look at fixed income and all the strategies that are being driven in a sort of kind of ESG informed way, that capital is going to go more and more to companies. So I think companies in the end are going to align to the standards that are out there. So I think it's not just the SASB of the world, but it's also pressure on corporate issuers to line up with those standards.
Should we do one more, Eric?
Sure.
How is this movement in responsible investing impacting how companies are managing for their performance versus managing on the values that investors are looking at for ESG? Either of you.
I think one sort of pillar. We talk about integration, impact, but it's the engagement piece. And so oftentimes companies are also going through this process themselves. And when we're large shareholders in many of these companies, and long own large pieces of the debt issuance. When we go to those companies and try to explain to them that it's important to have diversity on a board or other types of factors, they listen and are going through their own process of trying to implement these things to satisfy their shareholders. So I think there's a range of people that embrace it, and there's a range of skepticism. And I think that engagement and discussion that happens between us and those companies is driving the change. And in the end, if they don't change, then they'll end up, I think, not raising the capital at the prices that they need to grow their companies.
And I think that's a very important, when you're Nuveen, you can do that. And I think what you're going to start seeing is a lot of those companies having direct engagement with investors. And you're starting to see that trend already happening on issues like this. It is a competitive world for capital. And I think you're going to start seeing with this companies, and you're seeing that already, Tesla reaching out to retail investors directly, having conversations about investing. That direct-to-consumer investment relations type process. It's already happening, and we're going to see more in the context of responsible investing.
Great. Well, thank you so much, Mike, Hardeep. Thanks for spending time with us today.
Thanks for having me.
Thank you.